You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is commercial real estate attorney Phillip Coover. Phillip is an experienced commercial real estate attorney and advisor who helps clients find strategic solutions and maximize the value of their property. Phillip is skilled in closing complex, difficult transactions. His background as a commercial litigator, business owner, and licensed real estate broker provides clients a big picture approach to corporate and real estate transactions and acquisitions and sales. He also handles litigation, including receiverships and other distressed assets, foreclosures, commercial bankruptcy creditor representation, business disputes, and breach of fiduciary duties and debt collection. In addition to his activities as a real estate attorney, Phillip is also the host of a top-notch commercial real estate podcast called Real Estate for Breakfast. And I actually wasn't even aware of Phillip's podcast until very recently. But what I can tell you is that it's definitely worth a listen. He interviews some of the big-time heavy hitters in the commercial real estate world, guests that you probably won't find on other shows, so I recommend you go download on iTunes and have a listen to it. Now, based on Phillip's extensive background in the real estate world, there really are a litany of topics that we could cover on this particular show. But one topic that keeps coming up over and over again, and one that is of significant value and relevance for us real estate investors, is the one regarding opportunity zones. More specifically, what opportunity zones are and what the real opportunity is for us real estate investors. Now, by the end of the show, my goal is to demystify the topic of opportunity zones so that each and every one of you can make sound investment decisions. And so I'm very excited to get onto the show with Phillip. But before we do, here's a quick word from our show sponsor, Sunrise Capital Investors. Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. Now, without further ado, I'd like to welcome our guest for today's show, Phillip Coover. Phillip, how you doing today, my friend?
Kevin, I'm doing great. Thank you so much for having me on the show. I'm a big fan.
Wow, I appreciate that. Thank you for taking the time out of your busy day to join us here, especially the week of Thanksgiving. So I know you probably have a lot of family plans in store, and so we appreciate having you here on the show. And this topic is a very exciting one, and it's one that I'm hoping that most of the listeners at least have heard of it, if not, are well versed in it. But I'm guessing that based on the brief conversation, Phillip, that you and I have had before we started recording here, is that you're getting multiple calls a day asking about what opportunity zones are from your clients and how they can take advantage of them. And so obviously most folks out there are not well versed on this subject matter. And so we're going to dig deep into it. But before we get into it, if you would, I know I did an introduction there, gave a little bit of your background, but I'm sure there's a little bit more to the story than that. If you would maybe take a few minutes to tell us a little bit more about yourself.
Thanks, Kevin. I appreciate the opportunity. So I'm a commercial real estate attorney. I'm a partner and member at the law firm Clark Hill PLC. It's a national firm, 25 offices across the United States and Mexico and Ireland. And I've been practicing since I came out of, just a little on a personal note, I came out of law school in 2007, looking forward to doing some commercial real estate transactions. But then 2008 occurred, and there were none for 4 years. Mm-hmm. So I ended up litigating, doing a lot of bankruptcy, foreclosure, distressed asset work until the economy recovered a little bit. And I've been doing commercial real estate transactions primarily ever since. And we do a lot of multifamily work. We do a lot of commercial retail work, office buying and selling properties, leasing properties. And then, about earlier this year, in April of this year, one of my clients came to me and he said, "Have you heard about this new opportunity zones?" And I hadn't at the time. And so I started looking into it. And he was an early advocate of opportunity zones and some of his partners. So we ended up really getting involved and sort of absorbing all the information that was out there. If anybody is out there that claims to be a longtime expert about opportunity zones, don't believe them because it's brand new. It just came out in the Tax Cuts and Jobs Act of 2017. It was effective for 2018. And there's some guidelines that were recently issued in late October, which gave sort of a body to the rules that were in the statute. And so it allowed us to work going from there. So anyway, this client came to me and we've been working on a project with them. And then I ended up doing a podcast. I host a podcast called Real Estate for Breakfast, commercial real estate podcast. So we ended up talking about it there. And then we had a client come to us in August or so that said, "Hey, I'm looking at this deal in an opportunity zone. We're planning on doing this deal anyway. Can we structure it to try to qualify for these benefits?" And, we said, well, the guidelines aren't even released yet, but there's a lot here. And one of the nice things about working at a big firm is I have some people that work with me that are my tax geniuses that have been doing new markets tax credits, low-income housing tax credits for years. And so they're kind of familiar with some of the terminology of the IRS and how the IRS interprets some of the language and provisions. And so we were able to structure that deal. So, having done one opportunity zone fund deal in August or so, we ended up becoming some of the forerunners in the industry, and the word spread. We're getting more and more calls and conversations ever since. And, I had 3 calls on this yesterday. And so I'm hoping I can demystify it a little bit as you try to here. We can do it together. We can work through it and talk through it. And then I'll be able to share this podcast with some people.
Okay, fantastic. Well, why don't we start at the very beginning? You told us about the Tax Cuts and Job Act and kind of how this all came about. But let's lay the foundation here and give the as basic as it can possibly get. What is an opportunity zone?
Sure. So the tax provision says you can roll over capital gains. If you have a sale this year, you can roll over the capital gains and invest it in a qualified opportunity zone. The opportunity zones were designated by the governors of each state based on income levels for census tracts. And so we already know what the opportunity zones are. How we got there, not as important anymore. We know what they are. There are maps available on the internet. The EIG has a good one. Novogradac has a good one. There are a couple other interactive maps where you can search to see where the opportunity zones are. They're out there. I'm sure there's a lot of other good ones, but that's what I've used. And so if you invest in a qualified opportunity zone, either through a fund or through a business, or a qualified opportunity zone business, you have a few tax incentives that will help you. One, you can defer your gains from the initial sale. Similar in concept to a 1031, but it is more broad than a 1031. I'll talk about that in a second. The second advantage is that if you can defer the capital gains from this year, but if you hold for longer than 5 years, you get a 10% step up in your basis. So you basically 10% off your capital gains. It's a little more nuanced than that. If you hold for longer than 7 years, you get another 5% step up in your basis. And if you hold for longer than 10 years, any appreciation on the deferred investment is you're going to have a step up in basis. So essentially, you're not going to have to pay your capital gains on the appreciation of your investment. You are still going to have to pay capital gains on the initial rolled over deferred investment, but you're going to have to do that by there's like a 2026 catch, which the code says you have to pay on the deferred investment either on the earlier of the sale or December 31st, 2026. So if you're going to plan to hold for longer than 10 years, you do need to do some tax planning because you're going to have to settle up with the government on the deferred gains in 2026, but you won't have the related sale. So it's a little bit of planning, but you have some time to do so.
Okay, so 2026 until you actually have to pay the gains on the original deferred investment. But if you hold more than 10 years on the rollover investment, the one that you've put the funds into, essentially you step up the basis to where the capital gains are essentially eliminated, correct?
Correct.
Wow, that's pretty powerful.
Yeah, no, it's really exciting. You know, this comes as I think it's coming at just the right time. I have a lot of clients that have been transacting properties over the past few years, but they're finding that the market's getting a little tight. So people have been looking like, is the market going to crash? Is it going to be like 2008? Is it just going to subside? But this might be the shift in the marketplace that redirects some of the capital that's been placed, because I have people right now some of my clients are sellers, and they're like, we should sell now. The rates are good. They can get good prices out there, but then they're putting the money in 1031s and they're not finding deals that they like as much. So people are more and more opening their eyes to this potential opportunity to invest in opportunity zones. So it kind of comes as a nice time when people are looking to do something, and the traditional investments they've been making the past 4 or 5 years aren't as available.
Wouldn't some of the same challenges exist, though? Like with the 1031, I'm going back in time to 2006, when before the Great Recession occurred, real estate prices were at an all-time high. So great to be a seller, horrible to be a buyer. But if you're a seller, ultimately, if you want to defer your capital gains, 1031 exchange, and then ultimately, a lot of folks felt forced into buying something that wasn't all that great of an investment just because they wanted to avoid paying Uncle Sam. Do you still see the same potential risk here for sellers? Like, I feel a lot of folks get really caught up in the idea of, I don't want to pay taxes. I don't want to pay taxes, right? Like that's all they focus on. They don't necessarily focus on what is that rollover investment going to be? And so I guess the question I have is opportunity zones. In my mind, when I initially heard of this, before I really dug into the maps, I just assumed that it was probably in the worst parts of every city across the country, and ideally places where I might not want to invest my money. So can you speak a little bit more to that?
Yeah, absolutely. I think that's a great point. You should like the deal anyway. And
got it.
a lot of the areas that are opportunity zones are not places where you might place your capital before. And there are a couple things to unpack there. But I love the point. I love where you're going with this, is that, don't chase the deal is what I've been telling some people. And it's just, if you like where the development is, if you like where the investment is, if you're already in this space, or if you invest with people that have a track record in these types of spaces and these types of investments. If you're not used to investing in low-income housing, think twice about whether that's something that you should be doing right now with your capital. Maybe it is. Maybe it's a great time. Maybe you've been looking for an opportunity to get in, and you're there with somebody who has a track record and knows what they're doing. But it's just all types of investments are different. So I just caution people to make sure that the deal makes sense for them wherever they're investing. At the same time, I have clients that are already doing the purpose of this is a great time to back up a little bit as well. The purpose of this tax incentive is one of the rare bipartisan efforts that we have here today in this sort of fractured political climate. And without making any commentary on that, people on both sides of the aisle, I believe it was Cory Booker and Tim Scott, two politicians from both sides of the aisle, came together and kind of pushed this forward. I think this idea has been proffered several times over the years, but what we have here is a bipartisan effort to invest in low income and distressed areas. And so what we're doing is we're opening up these markets to available deferred capital that can be invested and improved. And so one of the noteworthy items is that you have to substantially improve the value of the property. So it either has to be the original use has to be in this opportunity zones, or you have to substantially improve the property. And the purpose of that is because they don't want you just to park your money there.
Yeah.
But the incentive here is to actually improve these neighborhoods and to invest. And the definition of that is you have to invest as much of as you bought it for, basically, without getting into the tax jargon of it. And so if you buy it for $200,000, you have to put another $200,000 into developing it and substantially improving it.
Mm-hmm.
Although I will say that the IRS ameliorated that component just a little bit in October when they released a guideline that essentially said that you can discount the value of the land. So if you bought a $250,000 property and the land was worth $50,000, you would only have to invest the amount of equal to the improvements.
The improvement. Okay.
Yeah.
Okay. Very interesting. Go ahead.
Yeah. So what I got sidetracked talking about got excited about the bipartisan effort that was involved there. But my point was that there's some people that are doing this sorts of projects anyway. And so this is a great chance for them to keep going with their projects. So, I'm here in Chicago and I have some clients that develop multifamily buildings on the south side and west side of Chicago. And so some of these are in opportunity zones, and they're just finding this a great way to attract new capital to projects that they're hoping to do anyway, or they've seen a project that required a lot of work, and now they're able to fund back these projects with new capital sources. And so it's, in my mind, it's almost like the director out in LA who's wanted to get a movie done but hasn't been able to find a producer to fund the project. Now they're able to attract the capital to get it done.
Yeah, I was actually going to ask, and I think you just answered the question there. Are there benefits, or those that are currently own investments within these designated opportunity zones, can they take advantage of this? And you just answered that question. So it sounds like the answer is yes.
Yeah, the one caveat, though, is one of the requirements is that the property is acquired after January 1st of 2018. So if you already own the property for a while, you're going to have a hard time qualifying for these benefits. But, let's say you owned a tract of land that's in an opportunity zone, some people are looking at this by saying, well, I have two options now. This could be great. I've been sitting on this land. Maybe I can sell this to an opportunity zone fund, because I have a little Google alert set up for opportunity zones. And I just got an alert just this morning. There was a fund that was created on November 14th based out of Chicago, and they funded $105 million within 17 hours.
Wow.
This Opportunity Zone Fund. Yeah, it's pretty incredible. That one just came across my desk this morning. It was like,
is that one of the big crowdfunding sites or no?
Origin Investments.
Okay, I'm familiar. Yeah.
Fund. Yeah, I didn't know. I don't know them, but that's big money for 17 hours. 425 investors in 17 hours. So some people are looking at this like saying, I've owned property in these opportunity zones, and now there's going to be all these funds that are looking to do something with it. So maybe I have some potential sellers here. And at the same time, you could theoretically pull together a fund because you have a captive asset. You own attractive land. So this would be great for developing an industrial building or an office building in this area. Let's get a fund together and I'll sell my property to the fund. The hiccup to that is there is a related party rule. The IRS has thought of this already. You can't own more than 20% of both sides of the transaction. So you could theoretically gather some capital and be a promoter of an opportunity zone fund and then sell it, the property that you already own, to your fund. You just want to make sure that you're not in violation of the substantial improvement test. Or not the substantial improvement, the related party test.
Got it. Okay. I know that you in the beginning, you had mentioned 1031 exchanges and some of the similarities. And I guess one of the questions that comes up is, the 1031, you have a certain amount of time to identify and then close out that 1031 transaction. Are there similar timelines associated with this qualified opportunity fund?
You have 180 days from the sale of the asset, just triggering your capital gains issue in order to place it into a qualified opportunity zone fund.
Okay. And I know that, I'd brought up some of the potential risks that at least come to my mind as far as just buying to buy and defer capital gains, right? Are there any other risks, being that this is so new, are there any risks that you see that folks should be aware of when they start going down this rabbit hole here with this opportunity fund?
Yeah, I think that there's a lot of risk. In most areas, the IRS code, we have a substantial body of law that we can rely on, and a lot of regulations and guidelines. So everybody should do this with a little bit of their eyes open, knowing that we haven't been through this before. We haven't seen how the IRS will treat these issues. We have a statute and we have some guidelines, but you should be a little bit cautious of that. The other thing that makes me cautious is kind of just going back to this point of you got to like the deal in the first place. Yep. So the word fund is a little bit confusing, because the word fund, I think in most people's mind, implies a large blind fund, where you have a large promoter who's gathering $100 million in assets, $200 million in assets. And I think with that, and with any promoter, with any blind fund, just be cautious of who's doing it and know who's your investors and what's their plan for this capital and how are they going to place it. So I think there's a lot of risk there in just investing in something and just making sure you do your due diligence, make sure you like their plan, you like where this is going, because what's going to happen, because this is a long-term investment. Yeah. This is theoretically, you're holding this for longer than 10 years to maximize your benefits. So it's going to be hard for you to get your money out. It's going to be, what is the exit strategy? Are we going to sell this in 10 years or, hold this for 15 years? What do these documents say about what I should do? What's going to happen to my money? So there's a lot of questions regarding that component. And then the other thing I just wanted to say about the fund issue is the other thing that's nice about this is that it doesn't have to be a large blind fund where you're giving money to a Goldman Sachs or some big investor, some crowdfunding source. Is that the great thing about this is that it has relatively low bureaucratic barriers to entry, although you're going to have some ongoing legal and accounting costs to make sure you keep this afloat and do it the right way. But you can self-certify. So you could theoretically, if you're a developer and you have a capital gains, you have a family office, or you have some private investors that want to develop in a project that you have, you can just create an LLC, or it has to be a corporation or a partnership. And we think that an LLC, as long as you have multiple partners here, will qualify. But you can create it and you can self-certify, which means that the IRS has put forth a proposed form for certification, and you can just move forward with the appropriate legal and accounting guidance and do this and put your money in the fund and have the fund invest in qualified opportunity zone business and do it property or development specifically. So if you have people that you trust, that you work with, if you like the deal, you can do this without being tied to a large fund where you lose all semblance of control. So that's kind of a nice component. So like the new markets tax credits, low-income housing tax, that's a lot of legal work up front to make sure that you get those benefits to have. It's a lot of choreography to get all the parties together. The nice thing about those, though, is you can be pretty comfortable that you're going to get the tax benefits that you're trying to get. Here, it's a little bit easier to get into the deal because you can move forward with it swiftly. But, we don't have nobody is stamping their approval on it at the outset.
Sure.
A little bit more risky in that sense.
Okay. You had mentioned in the beginning of the show a few websites that have interactive maps that show these different opportunity zones. Would you mind sharing that again? I didn't grab it. Maybe some of the listeners did, but I want to make sure we put it in the show notes.
Yeah. Economic Innovation Group, EIG, they have a really good opportunity zones page. I think, I could be wrong, but I think Sean Parker, one of the founders of Facebook, I always think of him as Justin Timberlake character from...
He was a Napster guy, right?
Yeah, and then he was Facebook. Okay. Now he's one of the leaders, and EIG has been a big promoter of this. I don't have any affiliation with them. I just know that they have a really easy to use map. Okay. And then the other one is kind of a funny word, but it's Novogradac. It's a gentleman's last name, Novogradac. It's spelled phonetically, and they're and they've been really big in the new markets and low-income housing tax credit space. And so my partner, my tax genius who works with me, he swears by them. He says that they're great. And he goes to their annual conference each year. They have a really nice opportunity zone section on their website that aggregates a lot of good content.
Okay. And I'm going to assume that this is just for physical real estate assets or development of physical real estate, not necessarily businesses. Is that correct?
No, actually, this is more broad than that. I genuinely, truly, Kevin, I really see most people talking about this in the real estate sense, but you can invest in an opportunity zone business, which could be any type of business. There's a requirement that a certain percentage, I'm going to forget what it is, of the income has to be derived from the active efforts within the opportunity zone. So they don't want someone to create a business and just get a PO box in an opportunity zone and say, oh yeah, we're headquartered there. Like many things, the IRS is onto that, and they want you to do it right and to invest. But the provision allows you to invest in qualified opportunity zone businesses, which could be a variety of businesses, except there is an exclusion on certain sin businesses. I don't have the list in front of me, but it's like golf courses, casinos. I think it's like something to do with liquor. There's a list of those, which is pretty common in the tax code to have these types of incentives exclude those types of businesses.
Does it have to be a like-kind exchange, or could one sell real estate, defer the gains from that, and invest in a physical business that does not have real estate attached to it?
It does not have to be a like-kind exchange, which is really unique. And that's why it's been referred to as a 1031 on steroids in some literature, is because you could sell your Amazon stock that you've had for 5 years, and you get to have capital gains and then invest in real estate. And that's something that's very different from the 1031 code. It's gotten a lot of people excited about it because, they have capital gains from other sources, sale of businesses, sale of stock, artwork, that sort of thing. It does not have to be like kind. You don't have to swap it out for a similar asset. You can invest it in real estate.
Yeah, that's fantastic. Okay.
Yeah.
Phillip, is there anything that we haven't covered that you feel is absolutely relevant for the folks that are listening in to know?
So there's a lot of different nuances. This is a good time. My compliance people will probably like me to say this isn't legal advice. This is general information, and you should always consult legal counsel for your specific situation. But I was thinking about you this morning. I was listening to your most recent podcast, and I was just thinking about Sunrise Capital. And, this could be something really great for you. Like when you take some raw land and you were to improve it, substantial improvement turn it into a mobile home park. I know that you have a lot of funds, and I'm sure you don't need my advice on what to do, but I was thinking about you this morning. I was like,
I appreciate that.
Really work well for Sunrise Capital, because I've noticed that you like the long hold, you like to have yield, and you're not just trying to flip properties.
Right.
So, and you do buy raw land and turn it into something and substantially improve it. I was thinking you're checking some of the boxes here.
That'd be an interesting concept, because one of the big barriers with our niche in mobile home park space are that municipalities, it's incredibly difficult to get anyone on board with approving one of these to be built. It's kind of like the not in my backyard syndrome, or, the tax basis associated with typically is not, not substantial enough, whereas they could build an apartment complex or a commercial property on that same piece of land and have a much higher tax basis. Or, just generally speaking, we've got a negative stigma attached to our industry. So it'd be really interesting, being that these are in areas where they want, to fuel economic development, how they would respond to the idea of putting in a new mobile home park.
Yeah.
Because in one sense they're saying, hey, we want to, we want to improve these, whether not necessarily blighted, but we want to improve these economically challenged areas, and we want people from the outside to bring investment into to fuel that. So I'd raise my hand and say, that's us. We want to do it. And here's what we want to build. They're going to say, oh, we don't want that though. It'd be interesting to see a response.
Yes, it could be good for branding, and that's probably has some negative connotations to it. But for just expressing to local municipalities what it is, it's an opportunity. It's an opportunity to improve your community.
Absolutely.
To bring capital into your community that might not otherwise find its way there.
Yeah, no, absolutely. That's interesting. Well, I appreciate you thinking of us. I do.
Of course.
We've shared a lot of great information here today, Phillip. But if you had one final golden nugget, and this is where we enter into the last segment of the show here. If you had just one final golden nugget of advice or wisdom that you could leave with our listeners today that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be? And I'll lay this out there. It does not have to pertain to the opportunity zones.
Great. Don't let the tail wag the dog.
Mm.
So this is a tax incentive, and I think you could apply this to other things, is don't chase the sexy new tax incentive if the deal doesn't make sense for you. And I know that's a theme that we've hit on a couple times, but I just like that phrase, and I think that makes sense. I had someone the other day that was saying, we're buying this property we're considering buying it for about $4 or $5 million. It needs about $1 million in improvements. But I'm thinking the land's probably worth $1 million. Maybe we could spend another $2 million improving the property. I said, well, you said it only needs $1 million in improvements for you to get the return that you want. He's like, yeah. And I'm like, well, then don't go invest another good $2 million into improving your property for the hope of some return in 10 years. Like, keep your $2 million for something else. So don't chase it. If the deal makes sense, if you're interested in opportunity zones, if you're interested in investing in distressed areas or working on a project and having the capital sit, then go for it and just do it with people you trust and do it. Mm-hmm. But don't let the tail wag the dog. And the other thing I wanted just to say is my friend Jack is a huge fan of the show. And when I first told him that I might come on the podcast, he wanted me to give him a shout out. So shout out to Jack.
All righty. Hey, Jack. Thanks for tuning in. Appreciate it. Well, good deal. Phillip, this has been a lot of fun, man. I really appreciate you coming on here and your willingness to speak about this important subject, and look forward to staying in touch with you. And, hopefully one day we'll be able to do some business together, this or any other topic regarding real estate. So looking forward to that. And other than that, my friend, you have a great Thanksgiving, and we'll talk again soon. Okay.
Oh, thanks so much, Kevin. I enjoyed it.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.